And Nitin Rakesh, a CEO and MD at Motilal Oswal AMC, joins us on the show right now. Nitin, let's start talking about the disbelief. And we were just talking a little while earlier that people are not ready to believe this kind of rally that we're seeing. The slight bit of uncertainty to when does it last?
Yeah, I think in a number of ways this was a disbelief rally going into the New Year's, especially for the resident, high net worth and retail investors who had seen a fair amount of value destruction over the last 12 months or so. So they really got caught by surprise. I think dollar valuations were very attractive, so we saw a fair amount of FII inflow of about $2 billion last month. And to that extent, I don't think the individual investors have had an opportunity to participate yet. And so at best, they've been sitting on the fence.
Right. You just told me, that people alongside disbelief are also using this as an opportunity to exit, saying that we're getting good prices, might as well just take it home. Yeah,
again, I think there is a segment of clients who've borne the pain for the last 12, 18 months. And even though we haven't seen a fair amount of exits yet, but people are questioning, whether this is an exit rally or entry rally. We definitely believe that the worst is behind us. I think at 4,600 Nifty, about 15,500 Sensex. Valuations on a one-year forward basis were fairly attractive, 20% below long-term averages. Most importantly, the macro environment seems to be stabilizing. So I think there are all indications that the worst is behind us. Interest rate cycle is firmly on the downtrend now. Even the RBI has acknowledged that. We've seen CRR cut. We've seen that statement coming out of RBI yesterday.
And that will be a big trigger for the market.
Absolutely. And again, markets look at two things: the macro environment, interest rates specifically, and earnings. And I think while we've seen the first trigger, we need to see...
Quarter 3 is almost behind us. How would you characterize
earnings have been, I would say, broadly in line. I think much worse was priced in, especially for sectors like banking. And I think that's been one positive surprise for the market. So clearly we've seen that in the stock prices.
Private banks this time put up a better show.
Always, because again, keep in mind that the quality of book for private banks is much better. So you were expecting, or market was also pricing that in because valuations of private banks were much higher. Most PSU banks are below.
Too much into the provisioning numbers shooting up for all of the public banks? Because there's a fear that these high provisioning numbers, the possibility of NPAs also going forward increase.
I think it was overdone because yes, there are provisioning numbers, but no more abnormal than what you would find in an interest rate cycle. And again, if you take out one or two large corporate names, then you clearly see that numbers aren't as bad as they made out. I think operating performance of most PSU banks has actually been pretty good.
Auto as a pack, you're bullish on the auto space, four-wheelers particularly.
Right.
Today we had auto sales numbers coming out from M&M. On a year-on-year basis, slight decline is what we saw. Maruti, Suzuki, most of them saying that Manesar is behind now. They're going to be going.
I think Maruti is more base effect because of the production issues they've been having last 1 year. M&M clearly is pretty robust numbers, and I've just heard the numbers, so we haven't analyzed them yet. But clearly, I think the interest rate sensitives are likely to do better over the next 6 months. Our call is typically banks are pretty attractive, not just private, but even PSU banks on a valuation basis. We also like, we've always liked the two-wheeler space, so we've actually had a pretty good view on that over the last 12 months. We also start to like the four-wheeler space, and there are interesting investment opportunities there as well.
Nitin, hi, afternoon. Simple question. Why do you think that the market has made a bottom? How many times in the past when the market got to whatever, 48, 47, 45, you thought, oh, this looks like a bottom. Maybe the market's done what it needs to do. We're up 10% and this will run. So how is this? We're just up 10%. Stocks have done more, but they did more on earlier occasions as well. 5 to be precise over the last 1.5 years.
I think that's a fair point. Keep in mind, though, that every time we saw a 5-10% rally, we saw a lower bottom. So while we are not saying that we bottomed for sure, that only time will tell. Definitely looks like there's a floor under the market now, given what we talked about on the macro and the interest rate side. And again, given that even from a contrary viewpoint, if you talk to anybody on the 2nd of January this year, almost everybody was on the same side of the trade, which was downside bias in the market. So I think both of these things have aligned well for the market. We've seen a pretty sharp rally, especially we've seen good flows, which is something that was missing in the last two or three times that the market gave a 10% rise.
It's still okay. I buy your point that this looks different. This feels different, but it always does. That's the caveat to it. But my point is, nothing has really changed, has it? Macro-wise, nothing has changed. We are talking about a potential start to RBI cutting policy rates. But if you look at what they're doing with the OMOs, it tells you how tight the liquidity situation is. Right?
I think that's a fair point. But again, keep in mind though that you've at least seen a stance change from RBI, which was tightening till November, December, to a pause, and then the CRR cut was really the first move towards the loosening policy, and obviously the tight liquidity is forcing them to do that, and liquidity is tight for a number of reasons. So our view is that we'll continuously see, at least the market is constantly going to start pricing in the fall in interest rates, and at some point that will be followed by the RBI action, whether it's in March or not is anybody's guess. And again, keep in mind, what I'm really saying is that it looks like there's a floor under the market. Whether we've bottomed for long, for the next 3 months, 6 months, 12 months, we don't know that yet. But clearly the valuations are supporting it. The numbers are looking fairly decent. If anything, it should be a buy and dips market, and obviously we can't predict what levels it will go up to.
Okay, all right. I'm going to come back to you on that point. Tata Motors January auto sales numbers are also out right about now. 87,465 units. That's come in now as we speak. I think the expectation was for them to do about 90,000 units or so. So these numbers are then in line with expectations, but more details in just a bit. We just have the basic number, close to about 88,000 odd units or so, 87 and a half to be precise, 248 on the stock. It's moving up a little bit. Nitin Rakesh is with us. We was in conversation with him. Nitin, so last couple of days I've heard it from lots of people that, so if you believe that the turn is happening, somebody even went to the extent of saying that we might be approaching something, not in the same degree, but in a smaller degree, a March 2009 kind of a moment. The implication was that through the course of 2012, a lot of stocks will double. There's a lot of money to be made. Do you look at it like that, part A and part B? How would you go about implementing that strategy if you do?
Again, I think I wouldn't make any dramatic statement like that yet. All we need to do is keep our head down and focus on what's happening at a macro level, what's happening at an individual company level, and focus on building the portfolios from that perspective. If obviously momentum comes back and flows stay robust as they've been in the last 30 days, then obviously we are looking at a fairly robust 2012. But let's not forget that there is a fairly high degree of uncertainty still out there, whether it's global environment, whether it is the local policy issues, elections, so on and so forth. So I think while things have improved, we've seen some signs of a macro reversal. We still haven't forgotten all of the issues that are out there. So I think the idea is not to take a prediction for the next 10, 11, 12 months, but focus on the here and now and what's the best environment or what's the best portfolio for the current environment.
Right. Okay. So you're saying so that answers it. So you don't think you getting that kind of a March 2009 kind of a moment or something of that sort.